maybe it's not always good for the market timing day in, day out, but are we talking about retirement planning day in, day out? And that's what happens is sometimes the narrative, you sometimes get to a knee-jerk reaction. Take the Trump trade wars, for example.
Welcome into Impactful Conversations, stories and lessons for financial advisors. I'm your host, Dave Edgecombe. Joining me, we've got a good one. I love to talk to smart people, and I think I have found myself a really, really smart person. We got Tom Haynes. He is the head of capital markets and index solutions with Annexus. He's even got more titles that he could tack onto the back end of it, but he's keeping it simple for us for right now. And we're going to kind of cover a wide variety of things, but I want to talk about the economy and what you see from your perspective and your vantage point, and what sort of moves the needle when you look at a day-to-day basis, and what kind of news sources you're looking at and how you make sense of it all. So thank you so much for joining us, for taking the time. We appreciate you coming down to our studio to share some time with us.
Well, Dave, thank you for inviting me on to the show. It's a real honor. I don't know how smart I am, but I'll definitely share the perspective. I think I'm lucky enough to have had through my career the humility of being around a lot of smart people that if you surround yourself with and you hear a lot of different perspective, it gives you a lot of insight. So that's what I would say. And this is a timely point in where we are in the economy, for sure. Not that it's never irrelevant, but here we have all this euphoria talking about AI. We're talking about Trump tariffs. Where are we with mortgage rates? Some of this is really relevant, and it's hitting people really at the kitchen table in the retirement savings. And then some of this is really just also noise that you don't want to get so enamored with, where you could derail your retirement planning goals.
I think you hit on the first thing that I want to get to, and that's AI. It is impossible to escape AI's reach and grasp, and it's a real talking point on Wall Street, I would imagine, with what NVIDIA does and how they're sort of in NVIDIA and 7 or 8 other tech companies that are really kind of are carrying the S&P 500. When you see that, and you see that it's 7 companies that are doing the lion's share of the lifting for the S&P 500, does that concern you? Do you think that that's sort of just the cost of doing business for where we are as a society right now?
On historical norms, it's not normal. It is the most overconcentrated market in my lifetime, and arguably studies have shown it's the most overconcentrated market going back really since the 20s. It's also, according to Bob Shiller, the 4th most overvalued market when we're looking at historical metrics of the earnings of the S&P 500 versus what the S&P 500 is adjusted for inflation. However, it's also not normal that within 2 minutes, I could type a little vignette and have myself doing flips right here, which I know I can't do, or speaking to you in Mandarin, right?
Yep.
That's not normal either. And when are we going to see AI? Me doing flips on the video right now isn't going to grow our economy.
Yeah.
But are we going to create an efficiency through AI that ultimately will help and create more growth for companies, including the rest of the MAG, not the MAG 7 only, but the other 493. And now that's challenging because that can be job factor considerations for the bigger economy, but getting more growth in the stock market is, I think, part of what you're going after.
Do those 7, I know it's kind of unprecedented, but it sounds like there are a couple of parallels throughout the history of the S&P. Is it a rising tide lifts all boats kind of thing, and we're just waiting for those other boats to sort of lift with it? Or is there separation?
Right now, there's the hope that it's the rising tide. That's the hope. Because can AI really help those other companies? Let's take Walmart, for example,
okay,
right? Or Expedia has already done it, that you can now go into a ChatGPT, let's say, and through a Target or Walmart, can you purchase goods where you're saying, not only I want to have this type of good, you might not know what you want, and using AI to help you do that. Or what about the simple processes of a back office of a company? The logistics, if you're running a Walmart, the logistics of trying to make that efficient. Is the CapEx, the capital expenditure investment they're bringing into AI, is it going to create more growth? Now, that might create more unemployment in the economy, but will it create more growth? And that's the big debate. If it creates more growth, the answer is yes, rising tides lift all these boats. Maybe it'll lift some boats. And then is there a potential fear that none of the boats rise? Probably unlikely. But then the other question is not if, because I think it will be if. It'll happen. but when. And the market looks at valuation about when. It's kind of like the old adage, what have you done for me lately?
Yeah.
So there's a timeline that the market is pricing in to lift these boats.
Mm-hmm.
And is that going to be a year or two? And if it's 3 or 4 years, I think then we're showing an overvalued market.
Is there, I mean, you kind of just hinted at a timetable there, but what's the timetable where it's, okay, someone needs to intervene or something needs to happen. The other shoe needs to drop, so to speak.
This isn't necessarily my specialty, but I would say probably in like 24 months, you better start seeing some real developments and not shiny objects.
Yeah.
We don't need to see, everyone, CEOs flipping and speaking Mandarin on AI. That's not what we're talking about.
I know this may not be your direct area of expertise, but we kind of talked about it when we were eating lunch earlier was, yes, that's talking AI in the tangible of what it is for the S&P 500, but I do want to talk about the noise and how the news can kind of get in front of people and maybe make them feel a certain type of way about how the economy is doing or how the S&P is faring. And that's what other people are doing. And I think the names that jumped out to me were Peter Thiel and Michael Burry. And there's headlines, oh, they're dumping. They're getting out of AI, or they are active on this front. And the average person sees that and says, oh my goodness, it's all coming true. That guy's getting out. Why can't I? What do you make of when you see a Warren Buffett or a big name that's in this field acting? And do you put any kind of stock in seeing that kind of action?
Well, I think you'll have to look at the collective group of financial experts.
Yeah.
And that sometimes includes academics. At Annexus, we pride ourselves working with a portfolio of academic elite. That's Robert Shiller, the Nobel laureate, to Jeremy Siegel, who's on CNBC regularly. He's been named the greatest stock mind alive, to Cam Harvey, and maybe at some point I'll talk about Ronnie Sacca, as well as Ibbotson. When we work with them, they're not going to have the same type of fanatical feel.
Or knee-jerk.
Knee-jerk reaction.
Yeah.
These people are very data-driven. Some of their data concepts are very modern and very technologically dependent of the data, and others are very much simpler processes. So what we get there is a kind of a more subtle long-term plan. Maybe it's not always good for the market timing day in, day out, but are we talking about retirement planning day in, day out? And that's what happens is sometimes the narrative, what you're getting at, that you sometimes get to a knee-jerk reaction.
Yeah.
Take the Trump trade wars, for example.
Okay.
Liberation Day, it was very unexpected. And I will admit that the financial strategies, the indices, they're rules-based, and the Annexus indices, many of them didn't do very well. Mm-hmm. And they actually sidelined for many months. And it was unordinary, unexpected. But what would happen is, at least in the index annuity process, I don't think that's a permanent situation. And two, that's a product providing 100% downside protection. In some instances, it's providing guaranteed income. But what about the rest of your portfolio, your equity portfolio? And it reminds me of the Friday after Liberation Day, I was in University City, Philadelphia, catching a train to go back up to the New York City area where I'm based. Mm-hmm. And I overheard a gentleman say that he just was talking to a family member, and he said, I got out of all of our stocks. I know it got a little tough. We lost some, but we're not going to have any more pain. And he made some critical remarks to the president. Mm-hmm. The irony of that, and unfortunate, is that narrative, sometimes your political viewpoint sometimes sways you to make irrational decisions in your market. Look at what happens to the invisible hand, as Adam Smith would say. What subsequently happened was, who's Peter Navarro? You don't hear much of him anymore. You had Secretary Bessent, Secretary Rubio work with the president, and things got a little more calm. And we saw this great recovery in the market, that we were at new highs by the summer. Mm-hmm. And here's this other gentleman taking this bearish view. And you might say, well, you're pinpointing one side of the political aisle. I could look at the other side. Those that have such strong patriotism. America is the best country in the world, and I think we're the leading economy. But when people say, well, I don't need to invest internationally because I think the international market and economy is a mess, I don't agree with them politically, that's myopic as well. Mm-hmm. That's where your patriotism becomes nationalism, and you start to also lose your opportunity to capture returns that we're seeing right now. Right now, the U.S. market is doing really well with the Mag 7, but actually, if you look at the rest of the market, it's the international names are doing better. So if you're taking a more even-keeled approach and less narrative, less knee-jerk, I think you're going to end up doing better. And it goes to the adage of those people, like if you miss out on the market, if you try to time the market with your equity portfolio, good luck. Good luck, which is really why you need more of a protection in the rest of your portfolio. Hence why we come together and we're proud to be partners with you at Impact and your advisors offering and developing an index annuity product.
You mentioned President Trump and how he has seemingly, it feels like his fingerprints are all over everything, and the economy is inherently connected to what he does. So how do you sort of weight it? How do you take what he does and relay that to how you guys need to be nimble with what you guys create at Annexus? And how do you guys prepare and plan for the inevitable volatility that kind of comes with what President Trump kind of brings to the table?
You have to have within the index annuity, you want to have numerous strategies that on a given year, if there's a zig in one market, there's a zag in the other. Mm-hmm. Right? That's really going to be important. But when we think about a presidency, he has 3 years left in his term. If you're thinking about one's retirement, is it 30 years? Arguably 35 years? That's like this. Mm-hmm. So I would argue that the tax planning of what the president has come up with and thinking through what the big, beautiful bill means for you and your clients, that's important. But don't get so in the myopic of what's just occurring right now. That's a market timing that I think is going to really hurt those American retirees. So we don't spend a lot of time getting overreactive to that. I do spend time understanding what regulations change from the markets. Okay. And how and what I mean by that is the cost of doing business. The government actually mandates how banks charge for trading. And the truth is these products are backed by Wall Street trades. So if the government is coming in imposing higher fees on banks to trade with insurance companies that ultimately have to create the product we're ultimately serving our advisors and the clients with, that's something I need to be considerate of. Mm-hmm. So those are policies I actually spend a lot of time thinking through as opposed to the movements of market volatility on a given month.
I mean, it's easy to take your eye off the ball because it does feel like there is a lot of noise. I mean, we mentioned noise once. We'll probably mention it again. But what do you use or what sort of metrics are you looking at when you're trying to assess the health of a market or an economy?
Well, in terms of the market for investing, it's bad always market timing, but you should have a fundamental nature, mm-hmm. right? And a lot of our strategies that our academics propose utilize some sort of fundamental valuation. Okay. And they're the worst market timers. That's why they're academics, right? However, they've proven over time, like Jeremy Siegel, the only market he failed to predict was 9/11. He's not in the CIA.
Yeah, that would have been a tough one.
And everything else, I've actually went back through CNN and CNBC. It was perfectly right on things. But, he's not actively managing a strategy. But they use a metric of fundamentals. And then we're utilizing a lot of times a metric of where the market is, the momentum. Now, one kind of new addition, we just recently launched an index with Dr. Ronnie Sacca and his business partner, Dr. Gideon, at MediaStats through MSCI that actually looks at the news and it collects the news to then discern what is a media narrative moving markets, which kind of makes sense.
This is fascinating. You mentioned this while we were eating lunch. This is fascinating to know more about.
And that was a missing link. A lot of our, what I'm stressing over and over again is let's not get so caught up into one TV network's narrative or one's personal belief. That can be a real risk. But when you start reading 135,000 websites every day for news and collecting that and recording that, now you're getting a real trend. Left-wing, right-wing, economically conservative, hawkish, dovish. You're just pulling all this in objectively, and you're able actually at that point probably getting ahead of the market. And when you think about when you're going to a cocktail party over the holiday season, you're not talking about the quality metric moving the market. You're talking about news. Yeah. And Dr. Robert Schiller talked about how news and narratives can really move markets, but he really had that in a theoretical mindset with his last book. And the team at MediaStats with Satkin and Dr. Gideon were able to make it implementable. So we're excited to that. Now, as far as I'm concerned, that's not the holy grail either. You got to bring it all together. Yep. We're not taking bets. And that goes back to that gentleman who I saw. He took a bet. He sold the whole market thinking that the U.S. economy was going to crater.
Yeah.
Well, that's a bet. So how do we do something with diversification, but then to dial down your sleeping point maybe is not to just sell off the market and go to cash. Maybe that's an opportunity to buy a retirement product, such as an index annuity.
One thing that came up, you mentioned my second favorite Charles Dickens novel when we were having lunch, A Tale of Two Cities. Thank you, Katie. But it does create this idea of the economy's doing really well. Just look. Well, if you go to the grocery store, a gallon of milk is this. And there are people that view that as sort of their metric for whether or not the economy is healthy. So the idea that there are sort of two Americas, or that there is a separation of what success is for Wall Street versus Main Street. And how do you guys at a Nexus sort of view that gap and then also potentially bridge that gap to offer maybe products that are more affordable or a better fit for the average person versus only catering towards the affluent?
That's a great question, because I think you would be really narrow-minded to think, well, the stock market, except maybe for the last few weeks, is at new highs. That means everything's great.
Yeah.
Well, first of all, you highlighted it's really led by 7 stocks. But when you understand the working American and those who are less fortunate, with inflation and the challenges of less production in America and keeping jobs, is a reality. It's an issue. And we also have the same issue when we think about retirees, right? Have they had enough to save for? Did their employer give them enough in their 401k to really make a means to live for another 30, 35 years? So that is a real risk. Now, for those that are completely have no means, that's probably where you need a government assistance, right?
It's a different conversation.
Trying is hard. But what about the middle class? And what I think about what impact partnership is doing with your advisors, we're trying to solve with products, let's say built by the Nationwide index annuities or Athene. We're trying to really also help the middle class. It's not just that you need a private banker. And I've worked at investment banks. I worked at UBS sitting down with billionaires. What I find refreshing here is to be able to help the middle class where they have a home. They might have some modest 401k savings. And how can they then have a plan of action? And a lot of times with the large wealth management firms, there's these higher requirements to get an advisor. $1 million. I mean, people might not have $1 million.
Yeah.
But to be able to know that, for example, one of the advisors that are part of the Impact Partnership or other advisors, they might be able to take that call and have something that is more realistic of a solution. And it's not a bet. It's really providing like maybe a need for income.
Yeah.
Right? Along with your home and Social Security. I think that's what's really refreshing, to give us access to that other part of the market. And we need to continue to do so. Because I don't think the large organizations will necessarily create a catering to the middle class. And it's naive to think that we're going to just start working with AI immediately, telling someone who has no AI experience, well, you build your financial plan with ChatGPT. And we're not there yet either. Maybe one day, but not today in 2025.
So story time, I'm driving home from picking up my daughter from school, and I stopped at a intersection where it's a brutal left-hand turn trying to get out of there, and there's a McDonald's in the distance, and I see that the McRib is back. Now, nobody's really that excited about the McRib, but there's this mindset that, oh no, the McRib only comes back when something's about to happen in the world. You have to kind of keep your eye on the ball now. That's unfortunately, I see McRib and I get concerned. What are you seeing that makes you concerned when you look at the economy?
You definitely look. I look at actually housing.
Okay.
Right. If the median age of a buyer right now is 59, that's part of the demographic of a baby boomer starting to downsize, which is a healthy thing. But when you see the median age of a first-time home buyer creep up now into your late 30s, that's concerning. Right. That shows you that the formation of families, be able to get out there and get a home. That's a struggle. And hence with the mortgage price rate, where that is at. Then you look at where employment and unemployment, that obviously is going to be consideration. And then to what you said earlier about inflation, right? Putting food on the table. And what is the cost of that? Now, we don't want to have fake inflation. And what I mean by that, where you look at one metric and look at the other. Like oil's really low right now. which is good, but groceries are high. So how do you get that collectively done and look at it in a way that you're really realizing that this isn't just government rhetoric. This is a reality. So we do look at those things. Does that necessarily change how I would prescribe what we do at a Nexus? Not at all. But I think it makes me cognizant of the reality of our economy.
I don't want this to feel all doom and gloom, because I think you touched on something when you talked about being myopic and people being blinded by their politics and not necessarily seeing the big picture or pausing and kind of taking in the whole situation. So you mentioned the academics that you work with, and I'm sure that you guys may not see eye to eye on everything politically, and yet you guys are still able to work together and find common ground with what you're working on. So what I want to know from you is, hey, how do you do it? But more importantly, why is that so crucial for you guys to have success, but for the average person to have success when it comes to their portfolio?
Yeah, we value working with real academics. And a lot of times I think we're not talking about the kind of some rhetoric out on campus that creates a lot of controversy or unrest.
Yeah.
The financial economists that we work with, and they're affiliated with some really large universities, some are a little controversial, but not them personally. They're very much objective view of the market based on their analysis. And through that process, they've actually found that markets go up. They actually see long-term, and Jeremy Siegel's the best. He has his book, Stocks for the Long Run.
Mm-hmm.
Stocks over the long run go up. So you want to even be tied to stocks, even in an index annuity allocation. Hence why we value that, as opposed to someone that's trying to sell you doom and gloom, right? What we other call a perma-bear. I recently, about 18 months ago, was presented an index that was really about doom and gloom. Mm-hmm. First, it was a little depressing, right?
I would imagine.
And two, the concepts that needed to be placed in the index weren't even implementable. They were far-fetched. To think that I'm not going to have any water in Atlanta, Georgia. I don't know. I think that's crazy. And when not to say we have environmental problems and things of that nature, but the academics that we see, the data shows long run, stocks do well. Stocks around the world, by the way. All around the world, if we do it, and they actually, what they highlight is they can do it in better ways. Not that the S&P is bad, but they can do it in different ways because there are different market cycles. And they also give us the mindset to think about how maybe other asset classes work. So that's why we value working with them. Why does it matter for a client? A lot of times, these are not household names. These are not people that have Fox News or CNN or MSNBC shows. They tend to be on the business channel. Those have lower ratings. We're not necessarily, I know we're in media right now today, but those people, they're not just talking heads. They give us a mindset where their data has actually proven in most cycles, not every year, to do well. And when we bring it together, it creates a nice diversification and their credibility. A lot of our academics are at a point in their life that they're senior citizens. They're already legends. They've all done really well for their means, but they want to give back. And that's why we value part of, when we think about the Impact Partnership, the Nexus Partnership, which we're proud of having you as one of our IDC groups, that they're giving back to and educating our advisors and helpfully trickling down to our clients.
And let the record reflect, I did not make you say any of that. You got there all by yourself. So I want to say thank you so much for taking the time to join us. I feel like this was really insightful and hopefully assuages some concerns that somebody might have with the market or what their options are going forward. So Tom, thank you. Looks like you got a last word. You got a last word?
Well, you have to adjust your sleeping point. And that's really
meaning
part
what?
of it. Meaning that if you could be all in the stock market, right? But you have to adjust to your sleeping point. And I don't mean sleeping point one night on, depending on whatever night concern you on the talking head on the TV.
Yeah.
But night in, night out, and that's part of it. Making sure you have enough savings for retirement and making sure you're adjusting your sleeping point. That's how you also manage what is the right allocation of a protected strategy in retirement.
I couldn't have said it better myself, so I won't try. Tom, thank you so much for taking the time to join us today. And thank you for watching. If you're looking for more ways to grow your practice, our YouTube channel is a great resource. You can watch House Rules, Selling with Stories. And of course, you must like and subscribe. That's the best way to stay up on all the recent content that we've created. So once again, thank you so much for watching, and we'll see you next time.